welcome into the Craig Houston podcast. You know who I am. I am Craig Houston. I'm with At Coastal Realty. I'm a local realtor in the Hampton Roads community. And in today's video, we're going to talk about exactly what's going on with the VA funding fee. If you have not yet heard, the Department of Veterans Affairs has announced that they're making a schedule change to the VA funding fee. And I think it's important to note exactly what's going on with it and when this schedule change is actually supposed to be impactful, because this may impact your next purchase in your next home, or it may impact you when you're selling your home that you're using a VA home loan to get into your next home. Because we always know one of the better things about the VA home loan is not only interest rates, you may find an opportunity to get into a home with zero money down. Those are always important things to me. But not only that, we're going to talk about in this episode today exactly how you may actually find an opportunity to not even have to pay that VA funding fee if you qualify by chance. And if you do qualify, how that opens you up to more buying power in your next home purchase. So wait a minute, Craig, are you telling me there's an opportunity for me to not only save money by not paying that VA funding fee, and we're talking thousands of dollars there, folks, but then also there may be an opportunity where you may be able to afford even more home? That's right. We're going to get directly into this video today. If you listen to this on stream, man, I'm glad you're here with me. But you always know I come with the tools and I come with the assets to help you understand more and more about what's going on in this real estate market. So this is one of the things that I really want you to do, whether you're a buyer or you're a seller and you're thinking about getting into this market, especially in Hampton Roads. Book your free strategic consult with me down in the description below. And man, that's all I need to say. Let's get into the video. So we're going to talk about first exactly what that VA funding fee purpose is, because to me, that's the most important thing to understand, especially if you qualify for a VA home loan. But you may be thinking to yourself, why don't I use FHA? Why don't I use conventional? And those may be opportunities for you as well. But I really want to get into exactly what I think that you need to understand about this VA funding fee and how it can be impactful to you, and what is it actually purposes is serving to the actual veteran community who qualify for these loans. But then also, not only that, I really want to break this down in a point of view from my perspective. So I'm not a lender. Remember, I'm just a realtor. So if I give you some type of information here, you always want to double check, back fit me with what your lender is saying and what they may say. That dude, Craig, is off the chain over there. But what I really want to do is give you a lot of detail and information, and definitely stay tuned because we're going to talk about how you may be exempt and then how this can give you more buying power too. So this is very important to me. It's something special to my heart. So let's get directly into it. But this first part to me is what makes the most sense. So the Veteran Affairs Home Loan is a government-backed loan, folks. That's important to note because the conventional is not a government-backed loan. FHA, the Federal Housing Administration loan, government-backed. Even some that's out there listening are going to talk about the United States of Department of Agriculture loan, government-backed. So there's three opportunities to get into the housing market, owning assets, owning real estate without actually being a conventional loan opportunity, and the loan is backed by the government. Now, there are some stipulations. There's always stipulations about using one of those government-backed loans, okay? Well, the VA home loan, you definitely got to have served in the military and qualify for certificate of eligibility from the Department of Veteran Affairs. That's the first one, okay? The FHA, everyone qualifies as long as they meet to the maximum income range and have 3.5% down. Then same thing for the US, the DA loan. I don't really know all the specs about it. I'm not going to get into it. Confer with your lender if you actually have questions about it. If you really want me to dive into that deep, let me know, and I will bring in heavy hitting experts to help you understand more about that. But when it comes to the conventional loan, a lot of people are unaware. When they hear conventional loan, the first thing I think about people hearing is, Craig, I can't do conventional. I don't have 20% down. I can't do that. 20% down helps you not have mortgage insurance premium, folks, okay? For those who are unaware what mortgage insurance premium is when it comes to a conventional loan, That means that if you don't put more than 20% or more down as a down payment into a home loan, then you are going to have to pay mortgage insurance premium, which is a guarantee to the lender that they're still making extra money just in case you default on the loan. Okay, so in Virginia per se, okay, let's just say in Virginia, the average sales price is about around 300,000 to be safe. Okay, now there may be opportunities in certain markets where you may see in the peninsula it may be 280, but then you come over to the south side of the Hampton Roads, it could be somewhere between 300 to 340. Just depends on what market you're in. Okay, so let's stay safe with $300,000, folks. If you're doing the math at home, 20% of $300,000 is $60,000. Okay, so who has $60,000 that they want to give up into an asset? I know I don't. Okay, I know I don't. Now, don't get me wrong, Craig. Well, you're a veteran. We know you qualify for the VA home loan, so you don't technically have to put no money down. That is one of the number one staples about the VA home loan that people hear: no money down. But that doesn't necessarily ring true when the market is so crazy and hot and volatile at this point in time. Okay, when you really think about this market, I really want you to understand exactly what we're seeing across the board right now. Yes, interest rates are up. I don't want to buy a house right now because the interest rates are high. I don't want to sell my house right now because if I sell my house, yeah, I may not get all the equity out of it, but then what am I going to buy? I know these are all questions that people have, and that is not the episode that we're in today. This is an episode where we talk about exactly how I can help you understand more about the VA funding fee. But just remember, $60,000 conventional loan. If you put 20% down, that's what you will have to come up with, $60,000 on a $300,000 loan. That means that your loan to value is at 240. That means that you actually own skin in the game. That means you own 20% of the home and the bank owns the other 80. Okay, that's really what's important here. So let's talk about what's going on with the VA funding fee, because now remember, if you put that 20% down on the conventional loan, you don't owe mortgage insurance premium, folks. Okay, now if you were to do that $300,000 and you only put your minimum 3.5% down, you're going to owe $10,500. Okay, $10,500 on your FHA loan. Now, this still means that you have to qualify to not only get into the loan, but then you're also going to actually have to still pay mortgage insurance premium. Okay, on top of that. Now, if I recall right, yeah, I know somebody's going to be out there like, Craig, you said that wrong, but I feel like if you get a loan, an FHA loan up to $625,000 or less, you're going to have to pay 0.85% mortgage insurance premium across the board for the life of that loan, or until you refinance it to a conventional loan. Okay, now this is why I want to say, this is my disclaimer: talk to your lending representative. Okay, I'm a realtor, not a lender. Okay, but I think that is accurate. Okay, so let's talk about that a little bit more here. So you're going to owe that premium on top of just only the mortgage payment as well too, if you qualify for an FHA loan. And I'm pretty sure it's going to be some of the same things for the USDA loan. Like I said, if y'all really want me to bring in a heavy hitter to talk to you about the USDA loan, let me know. We'll make it happen and we'll have that whole conversation. I think that is a well worth interview. If you find it in the comments, to let me know. So let's talk about why this is important to understand what that $10,500 looks like, because people don't realize you can only put 3% down on a conventional loan, and that's all you really need, but you're still going to have to pay mortgage insurance premium as well too. Now, if you was to save 3% on that loan, same $300,000 loan, that's $9,000 that you had to give up, versus in comparison to giving up $60,000 that you're going to pay over the life of a loan until you actually get that equity in a conventional loan. The difference between an FHA loan and a conventional loan when it comes to mortgage insurance premium, folks, is that basically you're going to have to pay FHA that mortgage insurance premium, but the life existency of that loan until you refinance it over 20% into a conventional loan. Okay. So that means if they do an appraisal on your home and it comes back that, hey, it went up over 20% after you actually pay for the home. So if it came in at 300,000 and let's say 300,000, I want to give y'all accurate numbers because I know people out there in math land are asking, Craig, what's that number? So $360,000 is the value that it came back or more. Then that conventional loan type will allow for you to actually not have to pay mortgage insurance if you refinance that FHA to conventional. Now, if you're doing a conventional loan, if you pay 3% down, you put your $9,000 into that $300,000 home, then what happens is when this market evaluation comes up to over that $360,000 mark, that means that you have 20% more likely the bank will actually send out an appraiser to actually appraise the home to validate where is it currently at, and they typically go ahead and release the loan for mortgage insurance premium at 22% without you asking. But if you ask, they will do it at 20%. You pay for the appraiser comes out, the appraiser looks at the home. If it validates it over $360,000 or more, then you're going to get your mortgage insurance premium actually taken off the loan. But the bank typically does it on their own if it's over 22% loan to value. Okay, so those are important things to note. Now, Craig, you said a lot of information. You said a lot, but really and truly, we heard about the VA funding fee. So why is that important? Because veterans, listen to me. I'm one of y'all, so don't be acting like Craig you don't know. Currently, right now, I'm still a senior chief on active duty until June 30th of 2023 in the United States Navy. So don't y'all be out here acting like I don't know. Veterans, we are one of the major ones who think that we are getting over on not paying this mortgage insurance premium. Well, really, folks, we're paying ours up front, okay? That's really what it is, okay? So that's really where it comes from. Now, I didn't get into the rate of the conventional loan mortgage insurance premium because I really didn't do the research for it, because I felt like mortgage insurance premium 0.85 on the FHA is definitely going to be a probably the same or a little bit more on conventional. Just generalities right there for me, right? If you really care about that, talk to your lender. This is why I say if you don't have a lender, reach out to me using that link in the description, and I will put you in contact with a lender who can break down a lot of these things for you, because my job is to get you into the home. The lender's job is to make sure that you qualify for the right amount of house, okay? So let's talk about this a little bit here when it comes to the VA funding fee. Currently, we're going to break down some slides here. So if you are listening to this on the podcast, this is why it's important. If you want more detail, to look at the YouTube video as well too. So let's get directly into what is going on here with this circular that the Department of Veterans Affairs is announced, and they want us to understand what is really going on with the VA funding fee changes. Okay, so the first things first, the new changes to the VA funding fee will go in effect April 7th of 2023, okay? April 7th of 2023. Now, that means if you close a loan today or you close a loan on April 6th, in time between today and April 6th, that VA funding fee that you've been charged, that you're going to get charged with, is going to happen. Now, this is important to note, realtors. This is important to note, buyers. That VA funding fee is actually going to reduce on April 7th. So as you're writing these contracts for closing in April, you may want to pay attention to April 7th. If you can save your consumer, your client, a few $100s here, or in some cases a few $1,000s, depends on the loan, right? This is important to note because this can make a major difference, and your client's going to love getting that extra little back at the closing table or in the escrow account, because you did the due diligence to understand that April 7th is an important date to note going forward, okay? So pay attention here, okay? Let's pay attention to what we're doing for our clients. Clients, understand, talk to your realtor and talk to your lender and talk to your title company about who's doing your closing, exactly what's going on if you're going to be closing around that time, okay? So pay attention to that. All right, so let's talk about exactly what this VA funding fee is giving us, okay? Remember, the VA funding fee is charged on VA transactions where the borrower does not meet the qualifications for a fee waiver. So we're going to talk about that fee waiver here in a minute, but also that means that the statute also provides for reducing funding fee for borrowers purchasing or constructing a home with a 5 or 10% down payment. Now, for loans closed on or after April 7th, okay, April 7th, must charge non-exempt veterans the new funding fee percentage from the loan fee table. We're going to break that down, so stay tuned. Stay tuned. But here's the important thing that I want y'all to know. The way the VA is writing this notice, they're telling you they're not changing this for the next 8 years. This thing is going to be in place for the next 8 years. Well, Craig, why did you bring that up? Well, the current status of where we're at with the VA funding fee went into effect in 2020. And it's already going out of effect in April 7th, which means it tells me that 3 years later, they're already like, oh, we're going to change this for the next 8 years. This may be an indicator to how they think the government thinks about what's going on with the housing market across the nation, okay? Across the whole United States. This can be an important factor to pay attention to. I don't have a lot of details into it right now, but as these details come more clear to me, I'm going to do more podcasts on this, and we're going to talk about this in detail. I'm going to bring in constituents to actually help me talk about this. So overall, pay attention to what's going on right now with them announcing this notice. It's going to be in effect for the next 8 years to 2031, okay? Now, there's some things in here about the 5 and 10% buy downs, okay, on your loan. We'll get into those as well, too. But just to be clear, just understand that if you actually buy a new construction that you already own the land on and you're wanting to build a new construction or dwelling, there's a difference here where that all that plays a part where you can actually use the dwelling's appraisal to actually as a down payment on what you don't have to pay against your principal loan, okay? That's really what that comes down to. But really and truly, let's keep it moving. Let's talk about exactly what's next over here in this circular as well too, because I think what's really important is that you want to see exactly what that funding fee looks like now between now and April 7th, 2023. And this is what I was talking to my veteran community about, right? If this is your first use of your VA home loan, you got to pay 2.3% of the principal payment of the whole loan type, okay, whatever the loan is, right? If you're not putting no money down and you take $300,000, you got to pay 2.3% of that in funding fee on top of that $300,000, okay? So let's just say that's what you're doing, okay? If that's really and truly what it is, that 2.3% is actually $6,900 that's going to be added on to your $300,000 loan. So that means now instead of having just a loan for $300,000, if you put less than 5% down on the loan, which means you can put zero money down, you're going to have a loan that's actually come in play for $306,900. What does that $6,900 actually represent? Upfront mortgage insurance premium, folks. Okay, upfront mortgage insurance premium. That's really what this actually comes out to be. And this is why I think it's important to note that you're not being exempt from mortgage insurance premium. You're just paying it on the front end if you're a veteran and it's already rolled into your loan. So it's part of your monthly payment that you actually have to make. And it's basically you're non-noticeable to it. You're not paying attention to it because it's already rolled into your loan. But that's really what it is. Now, if this is your second use of the VA home loan, because you already purchased the home before and it hasn't been more than 3 years and you don't qualify to be a first-time home buyer anymore, less than 5% on that actually takes you up to 3.6%. 3.6% means that you're getting $10,800 rolled into your loan at this point in time, okay? So these are the important numbers to actually pay attention to, okay? So we got $6,900 and $10,800 actually being taken into account if you are using your VA home loan for the first or second use, okay? Based on where we're at between now and April 7th, okay? Between now and April 7th. So that means April 6th, if you was to buy a $300,000 house in Hampton Roads, you'll be willing to pay more likely somewhere between $6,900 if you put less than 5% down, or $10,800 down if it was your second use and you put less than 5% down in Hampton Roads on the median sales price that we're typically seeing in this area. Okay. Now, this is important to note. That's why those are highlighted. Now, if you were to put 5% down or more, or 10% down or more, that VA funding fee becomes a little bit more tier. It goes down to 1.65 or 1.4. Now, that's really something to pay attention to because, right, if you say, let's just do the 1.65, right? Let's just say 5% or more. If you did 1.65% on a $300,000 loan, that's $49.50, right? Okay, and that's what's going to be the same thing. That's the max that you'll pay. So you're going to pay less than that if you did a 1.4 percentage loan, right? 1.4% is actually going to be somewhere 40. So between 4,200 or 4,950 if you was to put 5 or 10% down, which means that if you put 5% down on this $300,000 loan, right? 5% down is actually 15,000, or if you put 10% down, that's 30,000. Okay, so technically you're putting 19.4 down, 19.9 down, or you're putting 34 down, somewhere in there. That's the minimum. That's the range. Okay, so keep that in mind. But really and truly, paying attention to the VA home loan when we talk about this, zero money down or less than 5% is what a lot of people are looking forward to. So this is why this is important to understand this VA funding fee. Now, April 7th comes. All right, realtors, pay attention here. Okay, talking to y'all, if y'all listening to this podcast. I don't know which realtors out there listening to this podcast, but if they are, this is why it's important to know how much you can actually save your client. This is why it's important to understand that you need that strategic consult by using my link in the description, because people like me are paying attention to what's going on here in the market, especially if you're a veteran using your VA home loan. Okay, whether you're in service, out of service, you had that certificate of eligibility. This gives you so much flexibility and so much cost savings that we want to pay attention to it. Okay, so now here's the difference. It's not going to sound impactful a lot, and I already know this. But what I really want you to pay attention to, folks, is they reduce the caps on the first use and subsequent use of the VA home loan. It went from being 2.3% to 2.15% on your first use of the VA home loan. And then your subsequent use, your second use, is going to be reduced to 3.3%, okay, from 3.6%. Now, let's talk about those ranges of what that looks like on the median sale price in Virginia. Okay, so 2.15 in Hampton Roads percent-wise on a $300,000 loan is actually 64.50. Okay, 64.50. And if you actually use it on your subsequent use, okay, your subsequent use on a $300,000 loan is actually going to be $9,900. Okay, $9,900. So this gives you a little bit of an idea, right? That you basically saving somewhere between $450 to almost $900 on mortgage insurance premium over the life of the loan. Okay, that you're going to be paying over the next 30 years or so when you're actually using this loan. But here's why I think this is important to note, is because the more and more this goes up in value, we're only talking $300,000. Okay, let's talk about if you qualify for a $750,000 loan. Okay, and that's what the type of house that you actually wanted to buy. So let's talk about this from a 2.15 perspective on a $750,000 loan. And folks, you're actually going to spend $16,125. And if you actually did this on a 3.3 loan on that same $750,000, which is going to be actually $24,000 that you're going to be actually having rolled into your loan, $24,750 in comparison. Let's talk about the comparisons. So in comparison, if you did that same $750,000 loan plus 2.3%, that would have been $17,250. And then you would have actually seen also, if you use that subsequent loan on that same $750,000, it would have been, $24,750. No, I'm sorry, I did that wrong. I ain't do 3.6. $3.6 is $27,000. Okay, so Imagine that you wake up one day and you're actually doing this, and you say, okay, well, I'm planning on before April 6th to pay this VA funding fee, which comes in at 17,250 on my first use. And then actually you close on April 7th, you can save $1,125, or you can actually wake up on your subsequent use of actually using this thing, and you was going to pay $27,000, and you actually save $2,250 on your actual VA funding fee. Now, those are the important things. Now, also the 5% or more and the 10% or more reduces from 1.6 to actually, it goes from 1.65 and 1.4 to actually 1.5 and 1.25. So you're seeing a reduction there as well. We're not going to get into the details of that. But what I really want you to pay attention to, though, is this is important to note. Veterans, if you are actually getting out of the military and you're receiving a VA disability rating, you have just saved yourself so much money on this. Okay, you can save yourself $6,400 if it's your first subsequent use and you're staying in Hampton Roads and you're in that median sales price, or it can be up to $9,900 if this is your second use of that VA home loan if you're staying in that medium sales price range. But let's talk about it. If you're going to $750,000 because you've made it up in rank and you receive a 10% more than the 0% service connected disability, folks, you could be saving yourself somewhere between $16,000 to $24,000. To me, that's important to note, because if you get this disability rating, some people are unaware if your certificate eligibility is supposed to note it. It's supposed to notate it. Hell, there's people who are not even going to get their disability rating because they're unaware of the possibilities of actually saving on the next home purchase by using their VA home loan, by not only having to put no money down, but then not even having to put a VA funding fee down. That blows my mind. Here's a case study. Okay, folks, let's talk about it for a second. Craig, you're saying all this stuff, but how does this really apply across the board? I'm going to take you back to 2014. I'm going to take you back to a time where the market was still kind of like getting out of that hazy phase of what happened with the market recession in 2008. Okay. And then we came out of it a lot in 2010. But we purchased our first home in 2014 in San Diego, California. Folks, we own zero money down with a VA home loan. Okay. A $340,000 house. We put no money down. All we did was put our earnest money down, which is 1% of the loan value, which is $3,400. And our realtor did great negotiations for us. Shout out to Terry Davis out there in San Diego. But she definitely negotiated on our behalf to get us into a home where we got a lot of seller concessions. They paid the complete closing costs, and we actually received our whole earnest money deposit back, and we put no money down on that loan. Could you imagine if I didn't even have to put money down on that VA funding fee? I could afford it more home. Okay. Imagine if you qualify for a $750,000 home, right? Purchase, and you actually save somewhere between $16,000 to $24,000. That could put you in a range where you may be able to afford even a little bit more home and have a little bit more buying power negotiations at your ability, where you may even come out of the winner on both ends of this, where you may get an incredible home versus a great home. That can mean there's a slight difference in communities and neighborhoods in Hampton Roads, folks. So to me, this is important to note and understand that, right? Not only could you possibly not have to pay the VA funding fee, not only could you get more buying power, but if you actually get 100% disability in Hampton Roads, okay, in Virginia, in the state of Virginia, you get 100% disability, you can be waived from property taxes on your primary residence. Okay, folks, you hear me? You could be waived from property taxes on your primary residence, which could be another cost savings. So I think this is important to note. I really do think that the VA funding fee is something that you need to pay attention to. Veterans, be mindful. You may not be paying mortgage insurance premium outright, but you are paying it across the life of the loan as you're using that VA loan type. So it's always something to pay attention to. Now, is there certain situations where the conventional and FHA loan route may be more bang for the buck than VA? Not FHA more so, because you still got to put 3.5% down. But if you was already going to put that 3.5% down anyway, then it really makes no difference to you if you actually are paying that mortgage insurance premium on top of that, what we're calling the VA funding fee in your VA home loan. But if you was going to put 3% down on a conventional loan type, and it actually was going to save you more in that mortgage insurance premium, which I doubt, you should just go ahead and actually do a conventional if you're going to be putting way more than 10% down, in my opinion. Once again, not a lender. These are things that you want to consult with your lender that you actually want to work with when it comes to purchasing your next home. I just think that there's opportunities here that you can actually make money, save money, have more equity built up in your home over time without you having to put a lot more of your own cash or assets up to get into that home. And I think that's the more important thing to think about considerably as you go forward. Now, I know there's going to be people listening to this podcast, listening to this on the video. If you have questions, or even if you have comments, or you have things that you disagree about what I said completely, I welcome the conversation. Please do, and let me know. But I feel like we're in a space where we need to have these type of connections and understand exactly what's going on. And I hope that I broke down in detail to you what's going on with the VA funding fee that's coming up, those changes that's taking place, and to be aware of if you're going to be closing on a loan for a home in April. Pay attention to April 6th and April 7th if you are using the VA home loan, because this could save you possibly at a minimum hundreds of dollars, but also at a minimum can save you thousands of dollars, okay, overall. So pay attention to what's going on out here in the market. And if you like the type of content that I provided you with today, remember, my name is Craig Houston. I'm with At Coastal Realty. I'm a local realtor in your Hampton Roads community. And if you want to know more about buying or selling your next home or the home that you're currently in, use my link down in the description below and stay tuned for more videos like this. I'll talk to you soon. Thank y'all for listening. Peace.